As we all know, the Biden administration has proposed some material changes to the tax code, which will end up impacting business income, personal income, as well as potential wealth that some of us hope to pass down to our heirs. Our goal today is to try to hit as many of those topics as we can. And while we certainly don't have greater insight on what the outcome will actually be, obviously we can talk generally about the numbers involved. And so to get started, we're going to have the panel introduce themselves first. Dana, do you want to start, please?
Sure. Hello, I'm Dana McCartney. I'm a tax partner at Maxwell Lock & Ritter. I have over 20 years of experience working with business owners and high net worth individuals and their related entities on tax compliance and consulting, including gift and estate tax planning. I'm also a member and a former president of the Estate Planning Council of Central Texas and currently a member of the AICPA Tax Resource Panel.
Vanessa?
Sure. Hi, all. I'm glad everyone could be here today, and I'm excited to be here as well. But I am a wealth management partner at MLNR Wealth Management, and so I spend really a lot of my time helping clients develop comprehensive wealth plans. So that usually entails me working pretty closely with their tax, legal, and other trusted advisors to help them think through complex financial issues. And so that is, and taxes often come up. So I think definitely what we're talking about today is something that I've been hearing a lot about in other conversations.
John Gorman.
So, my job's a little bit different here. My job is to try and make sure business owners create a lot of wealth. And so, we all kind of work together here. But John Gorman, I'm a founder of Owner Resource Group. I co-head the private equity team here. Owner Resource Group is a private equity firm located in Austin, Texas, and we were designed actually and formed to work with closely held businesses. So, a lot of the things that we do are very focused on how to work with closely held businesses, support their growth. And although we're not tax experts, we certainly do understand and work with a lot of tax advisors to make sure that we can do things as efficiently as possible with business owners. So I look forward to this conversation. I appreciate you moderating this, William.
Thank you. As you all know, this is set for an hour and we will be prompt and we'll try to cover as much territory as we can in that hour. So to get started, Dana, can you set the stage for where we currently stand on proposed changes to the tax code? And more specifically, please point out what you think the most impactful change could be.
So I think for this audience, the considering a sale of a business or appreciated assets, the proposed increase on the capital gains tax rate is probably of most interest. So currently the top capital gains tax rate for long-term capital gains is 20%, but under the Americans Family Plan, the Green Book proposal by the Biden administration, they're looking at taking that up to the ordinary tax rate for gains over $1 million. And so we're talking about changing from 20% to 37%, or if they also raise the ordinary rates, 39.6% in 2022.
So let's take a specific example. If I sell my business with a $10 million gain, what would the difference be?
So under current law, if you sold that business with a $10 million gain in January of 2021, you would be looking at a $2 million tax. Under the proposed law, you would be looking at a $3.76 million tax just on the income tax.
And does it matter if I'm a C Corp, a Sub S, or a flow through?
So it does matter. C Corps are, sale of C Corps is always subject to the net investment income tax, and that's a 3.8% tax. Currently, if you actively participate in a flow through, a partnership or an S corporation, then the sale of your business is not subject to that net investment income tax. But also, under the current proposals, they're trying to make all income either subject to self-employment tax or to the net investment income tax. So that $10 million gain would then, even if it's a pass-through, be subject to the net tax, and at 3.8%, another $380,000 of tax that you'd be paying next year.
So some of the other material changes I've read, there's a proposal relative to gifting wealth to my kids, or if I died. Can you speak to some of the impact of what those changes might be?
Yes. One of the proposals, which I think has caused a lot of stir, is taxing a built-in gain on gift or death. And so, currently, when someone dies, their assets are passed on and may be subject to an estate tax, but there's no taxation. You get a step up in basis to fair market value, but there's no tax on that difference between the fair market value at date of death and the original cost basis. But under the proposal, that gain would be subject to tax. Now, they are talking about $1 million exemption, and there's some other exemptions for if it's goes to a spouse or a charity. And relevant today is that tax could be deferred if it's a family-owned and operated business. But that proposal, they've got a lot of aspects to it to try to prevent people from circumventing it. But that would be a really big change in current tax law.
And another big point, if the legislation passes, when would the rules be effective? January 1, 2022, date of the passage, or date of when Biden first announced?
So most of the proposed changes are proposed to be effective of January 1st, 2022. However, the capital gains tax rate increase from the current 20% to the top ordinary bracket. Under the proposal, they indicate that it would be effective at announcement. And generally speaking, everybody thinks that announcement was April 28th, 2021, when President Biden introduced the American Family Plan.
So I think what everyone on the call is most interested in is our cumulative opinion on where this is going to shake out. So if you're going to handicap this and you were the one finalizing kind of what to expect, where would you come out?
So obviously none of us have a crystal ball, and the sausage making is something that we're all waiting to see. But generally speaking, I think most people have talked about the fact that if the capital gains tax rate goes higher than 28%, that most economists would say that would actually generate less revenue instead of more. And so we're kind of expecting an increase in the capital gains tax rate, but not all the way up to 39.6, probably somewhere closer to the 28%. And also, I know it's kind of worrisome if April 28th is already passed, do you even have a chance to plan? But generally speaking, even though we have seen retroactive tax laws in the past, nothing as substantial as this has been retroactive. And most tax laws are generally effective when the legislation's introduced. So since no legislation has been introduced yet, we think there may still be an opportunity to plan, and that legislation will probably come late summer or early fall.
Thank you. Vanessa, given the uncertainty, you work with a lot of business owners. What would you recommend they be preparing to do currently?
Well, certainly, I think those business owners, particularly those who are already looking to sell or considering a sell somewhere in the near future, I think really need to kind of start with that exercise now, so that, while we are uncertain about some aspects of the proposal, that they can at least start that process and start preparing so that when the time comes that we do have more clarity, there is still time to act. And I think that really one of the initial steps should be to really contemplate or revisit what I think is a fair sales price. Because I think when it comes to the sale of a business, this is an asset in which a business owner may literally have probably poured their blood, sweat, and tears, maybe for even decades. So I think the tendency sometimes is to perhaps anchor to a particular sales price or the highest valuation that they can get from a bidder. But I think sellers need to keep their eyes on the prize. And in this situation, the prize, so to speak, is going to be the net after tax proceeds, so not the gross sales price. So it's kind of a balancing act because, if you hold out to receive a certain price, it may come at a particularly high tax cost. And so in maybe even some select situations, it might make sense for certain business owners to slightly discount the sales price if it could increase the chances that a sale could occur before tax rates go up. And then the after-tax proceeds are either equal or maybe even slightly better. That's on one hand. On the other hand, you can certainly fall into a trap on the other end of the spectrum. And I say that any transaction that should occur, you have to make sure that ultimately the economics work out. I know taxes are scary and they are certainly an important consideration, but they should not be the only consideration. So don't let the tax tail wag the dog, especially if it could lead you into a bad deal overall.
Thank you. John, I've seen your funnel of possible deals and the number of companies you all deal with. So you all are actively talking to, tens or hundreds of business owners real time. What impact are you seeing that this uncertainty is having or not?
Yeah, so we've clearly seen some business owners be very motivated to try and affect the transaction this year and sooner rather than later. It's generally been people that we in general have known a lot of our companies that we, look to invest in for a long time. So, it creates a pretty fast, efficient process for us to, start that conversation and give our feedback. And we want to be, especially in this environment, extremely quick on our feedback because back to what Vanessa was saying, a private equity transaction or any transaction doesn't happen in 2 weeks. You're talking, 60, 90-day period of time. And if you're trying to race against legislative changes or January 1st, 2022 implementation, you kind of have to make that decision now. And so we definitely have multiple conversations going on. I really kind of view this environment as this is getting past, and it doesn't hurt to talk to people. And if you planned on selling your company in the next 3 years, unless you really like giving money to the government, have some conversations. At least have them, in my opinion. It might not come to fruition. It might not happen this year. It might not be something that ultimately drives you. But, if it's been something that you keep on saying to yourself, I was thinking about selling my company in 2 years or 3 years, you're just going to pay a bigger tax bill. And you got to do a real cost-benefit analysis against the valuation.
So along those lines, Dana, let's talk about what we know and can control versus the uncertainty out there. How can a seller today be an efficient seller from a tax perspective?
Well, William, one of the things that's available in the tax law currently is what we call the qualified small business stock exclusion. And that is a very powerful exclusion in the fact that you can exclude up to 10 million or 10 times your cost basis of gain from being subject to tax. However, there are very specific limitations on that, and the biggest ones usually are the fact that this is only available for C corporation stock and that you have had to held the stock for at least 5 years. There's all kinds of additional requirements and planning opportunities, and it also depends on what year you invested in the stock as to what your exclusion amount might be. But for closely held businesses, if you're a C corporation, this is a big opportunity to save tax. And what's really wonderful on this is that there's currently not any proposals to do away with this exclusion.
So we've talked about trying to get ahead of this and planning. If I'm considering gifting a sizable amount to charity or passing down wealth to family members, should I plan to act before or after the final legislation's passed?
So acting sooner rather than later is almost always better in the tax planning. So if you're giving appreciated assets to charities, it's usually more tax efficient to donate that appreciated asset rather than selling the asset and donating after tax proceeds. But it also depends on what kind of business you have and what kind of charity you're donating to. And so you really want to be careful if you have a closely held business and you have charitable intent to talk to a tax advisor and make sure that you do that correctly.
So I've got 5 kids and 11 grandchildren already, and obviously have gotten focused on wealth transfer. I was looking at the historical estate tax exemption amounts, and they are currently at an all-time high. What recommendations do you have on that, and do you see that number returning to the historical norms?
So as far as where we see that going, it's always gone up. But in this case, when Congress enacted the doubled the exclusion from the 5 million to the 10 million index for inflation, they had a sunset on that, and that sunset is December 31st, 2025. So if no action is taken by Congress, that what's currently about 11.7 million of exclusion, we expect to go down to 6 million in 2026. So the other thing is, when we're looking at estate planning, we're looking at getting appreciation out of an taxpayer's estate. And if your asset that you hold is an appreciating asset, the sooner you get it out of your estate, the more appreciation you're able to get out tax-free. So though it's sometimes hard to give things away, there are tax benefits to doing it sooner rather than later. And then just, as we talked about earlier, if there's going to be a tax on gifts and estates, as there is under the proposal, definitely acting before that is enacted is going to be tax beneficial.
So if I gift it or set up trusts, do I still have access to it or not?
There are some trusts that do allow for spouses to have access. So the slang is SLAP, but the spousal lifetime access trusts are usually what are used currently in order to still allow individuals to have access to the assets that they're ultimately getting out of their estate before death.
Great, thanks. Vanessa, what else should business owners be thinking about? More specifically, what are the best ways to be strategic as a business owner who particularly knows that they're going to have a liquidity event sometime in the future?
I think one of the most important things to do is really take inventory and look at the big picture, because a lot of the business owners that I work with, they've invested a lot of their time and resources to really build up the value and the asset of their closely held business. But it's quite a transition once the business is sold. So you've got to really think about, well, how are you going to extract the wealth from this business that you've been building up over many, many years? And how is that going to support kind of your longer term lifestyle, long-term goals and needs? So I think it's helpful to really go through that planning exercise before a transaction and planning what that's going to look like after the fact. So particularly right now, what I'm doing a lot of is either rerunning or evaluating long-term wealth planning scenarios based on possible tax rate changes, looking at, worst case scenario, what if capital gains, the rate really does go up, 20%, or what if it just increases moderately up to 28%, and then see what's the domino effect, because that's going to impact lifestyle and cash flow needs for a business owner and their family, long-term or in retirement. It could impact their their legacy goals or wealth that's left for heirs and for next generations, and can also impact charitable goals as well. So it's really thinking about what's the long-term impact around those kind of bigger issues.
So go one layer deeper, and you might want to comment on the 401k that they may have, the SEP, as well as charitable contributions and distributions.
Yeah, I think right now, especially with the fact that there's been talk about a threshold, if you have income over $1 million, and you would be subject to the higher capital gains tax rate. So regardless if you're looking to sell immediately or not, I think there's going to be much more critical planning that needs to be done to try to keep income under that $1 million threshold, if that's where it actually ends up shaking out. So some things we can look at is how do we reduce income, and one way to do that is through maximizing pre-tax savings. So a lot of business owners may have already set up qualified retirement plans, or it may be something to consider. I think a lot of folks are more familiar with defined contribution plans like a 401k profit sharing plan or a SEP IRA, where you can make annual contributions. And those are typically, right, this year capped at $58,000, and that's a way to reduce your taxable income. Now, one other plan that is available, it's not as widely used, there are some more restrictions around it and rules, but a powerful tool can also be to couple in and bring in what's called a cash balance plan. And it's unlike a defined contribution plan, it almost serves like a defined benefit plan. But these plans are set up and you can make annual contributions to them, and it's going to be dependent on the owner's age and income, but in certain circumstances can actually exceed even $200,000 a year. So depending on the situation in the company, it may be a really good fit, and again, a way to really make a sizable dent in terms of reducing taxable income by making these contributions to these defined benefit plans.
From an age standpoint, does that make a material difference in your planning? If your business owner's 50 or if he's 72, would you go down a different path with the older person?
Yeah, certainly. For, as I just mentioned, the cash balance plans, you actually, the older you are, the larger the contributions you typically can make on an annual basis to this cash balance plan. So age certainly does make a difference. Another consideration is that once folks reach age 72, that's typically the age when you start having to take required minimum distributions from IRAs. And that's typically taxable income to that individual. So Dana mentioned earlier being efficient about making charitable contributions. So for those folks that are in RMD phase, where they're having to start take those annual distributions from IRA accounts, to the extent that you have charitable intentions, you can actually set up what's called a qualified charitable distribution. And it's basically a direct transfer of funds from your IRA paid directly to a qualified charity. And as long as kind of those certain rules are met, that qualified distribution can satisfy your RMD amount for that year and reduces your taxable income for the year. So again, and just another way to be really efficient if you have charitable intentions and you're looking for ways to reduce your taxable income, there are certainly ways to do that.
Thank you. We have a question that I'll read. I think, Dana, you're probably most qualified to answer this. It says, just to confirm that if we assume a new cap gains rate of 28%, any taxable gains up to $1 million will still be at 20%. How does the taxpayer's other taxable income, like W-2 wages, affect this $1 million threshold? Does the $1 million only get applied to the cap gains or on all taxable income?
Well, William, the way the example is in the Green Book is if you have 100,000 of wages and other income and $1 million of capital gain, then your taxable income would be that 1.1 million. The $900,000 of the capital gain would be at your 20%, but that $100,000 that's over $1 million would be at the new higher, either 37 or 39.6%. So, so we're looking at taxable income, and any taxable income over $1 million would be the capital. Basically, all income over $1 million is going to be subject to that highest tax rate of currently 37% and prospectively 39.6%.
Thank you. Yeah, for those on the call, feel free to use the Q&A. We will address them as we have time, but we will certainly try to get to all of them. So given that there is a cliff when it comes to the $1 million, does the concept of an installment sale, is that something that business owners should consider, or are there traps involved with installment sales? Vanessa or Dana?
Sure, I'll jump in initially, and I think it really, they could be a useful tool depending on the situation. If you're a business owner and you're looking to potentially make a sale relatively quickly this year before the tax rate changes go into effect, you likely don't want to push sales into a year, next year where rates could go up. You likely want to try to get that done, sooner rather than later. But let's say the tax rate changes go into effect, you find yourself in 2022, and again, you're looking at ways to try to stay under that $1 million threshold. An installment sale could make a lot of sense. So for example, say you have a piece of real estate that you're looking to sell, and you break that out over 5 years or 10 years, just to realize that income in smaller chunks every single year. So from that perspective, it could make a lot of sense in ways to structure an installment sale. Now, if you're selling something with a really large gain and it's going to push you over that threshold anyways, it might not be a useful tool. So it just depends really on the size of the gain, and if you're close to that income threshold or cusp, and that's just one way to try to keep you under that $1 million mark.
You mentioned real estate sales. I think there's another item that we might want to spend a little time on. They are recommending the elimination of property swaps. Vanessa or Dana, any comment on whether you think that will pass? I would assume the real estate lobby is quite strong, and this is not something that they would be excited about.
William, I definitely think you're right there, because the like-kind exchanges have gone away for everything except for real estate currently. So I am sure they're already lobbying hard to keep that like-kind exchange. Under the current proposal, they're limiting that like-kind exchange, I believe, to 500,000. So it wouldn't go away totally, but they're definitely looking for opportunities to tax things currently instead of, the example that people are talking about and what some people consider abusive is if you do those like-kind exchange over and over and hold that property until death, then under the current law, you get that step up in basis. And so all that capital gain over the years escapes income tax. And if the property's then sold right after the death of the holder, there would be little or no gain. And so it seems like in looking at the Green Book, the changes to the capital gains tax is the largest increase in tax revenue that's part of the Green Book, and so at least on the ones that we're talking about. And so that seems to be a big focus of how can they tax more appreciation.
John, back to installment sales. You've been involved with a lot of transactions. You've negotiated a lot of earnouts. Have you ever been involved in a installment sale, and is that something anyone's currently talking about?
So no, we're not actually currently talking about it. We do talk about earnouts a lot because it's one way to bridge valuation gaps. So it's something that we end up having lots of discussions with business owners about. Installment sales, we don't typically have that. But it would make sense depending on the taxable situation of the individual, especially with that level of threshold to be able to, say, okay, well, let's make annual payments for the next 5 years and put it at a threshold that keeps them under that $1 million, just to make it a little bit easier for that individual. And we actually, one of the things that we really pride ourselves as a firm is that we don't have a cookie cutter approach. And so, what we really like to do is, work with the individual, understand their circumstance. The valuation is going to be the valuation. I think, as the world has matured in the corporate finance world, I think a lot of people have a pretty good understanding what their business is worth. You're not going to have these, huge differences. Sometimes you have huge expectation differences because everybody's got a friend who sold their company for 10 times the EBITDA multiple and thinks they should get the same thing, which, isn't reality, but, you kind of live through that. But, what we like to try and do is really customize something, is try and figure out, and that includes trying to do it tax efficiently. Like, how can we help the business owner do something that's tax efficient for them and structure the transaction in a way that works for all the parties involved in the most efficient manner and meets their needs. I mean, that's why we are talking to multiple people who want to try and expedite right now a transaction to get something done before there's a tax law change.
Let's migrate to deductions. It's certainly historically been a way to reduce the amount of income tax we pay individually. Dana, they're talking about eliminating itemized deductions. Any comments on that subject?
So I know one of the proposals that has been talked about on the itemized deductions is to try to not totally take them away, but to limit the benefit. And so, currently, if you're being taxed at that top rate of 37%, then any itemized deductions, your charitable contributions, your interest and taxes that you are able to deduct, you get a 37-cent benefit for each dollar. And so what has been talked about is limiting that to a 28% benefit. And so, how that would actually work mechanically, we haven't seen, but there is talk about trying to reduce the benefit for those high earners of the dollar for dollar reduction in taxable income.
And then with the 2018 changes, we were no longer able to deduct state and local taxes. I know that New York and California representatives in Washington would like to basically reinsert the ability to make those deductions. Any sense as to how that will fall out?
Well, we really kind of expected that to happen quickly. We even had talked with some of our clients about postponing some of their property tax payments into 2021 with the expectation that SALT cap would go away. But as it turns out, that was a huge revenue raiser. And so though Congress would really like to make their constituents happy and let their property taxes and state and local income taxes in excess of $10,000 be deductible, that what we are hearing is that the dollar figure is so big they haven't figured out how to pay for that, and so that's why it's not in the current proposal from the Biden administration.
Thank you. John, in your conversations with business owners, does the concept of after-tax proceeds ever come up, or are they just focused on what the offer number is?
So it varies. I think generally at first people are focused on what the top line number is, and I think secondarily they become focused on what the take home is. And it does vary by individual, and we focus a lot on trying to show people what their proceeds from the transaction will be. Like, there's a headline number, but that's not the ultimate what you're going to put in your pocket, and try and give them some guidance as to what that ultimate cash amount coming to you individually will be. And then there's also, quite frankly, like it's different by state even. I mean, and so you got to take some of that into consideration. We have a transaction that we're pursuing right now in Iowa. And in Iowa, there is no capital gains in the state. You just get taxed ordinary income when you sell your company there. But if you've held the company for more than 10 years, you don't have to pay any tax on it. So like we're very specifically structuring the transaction so that there's no state tax too. And so, you know, we kind of have to focus on all of those pieces.
And then to all of the panelists, we've been talking about things that business owners should consider doing. Is there anything that they should absolutely not be doing?
Dragging their feet and not doing any planning, what I would say. You know, you have to evaluate it. Maybe you come to the conclusion that you don't do anything, but I think it's certainly, you have to go through the exercise of just thinking through what are the different possible outcomes, how is that going to impact, you know, long-term planning, because it's a lot harder to do something after the fact rather than kind of doing something before. So having the conversations, thinking about it, dragging your feet is not going to help anyone. I think especially the attorneys, and what they don't want is everyone calling them up on December 15th if we have an effective date of January 1, 2022, it's going to be a lot harder to get anyone pick up the phone.
Yeah, and I'd probably echo that, which is, listen, for almost every company we deal with, this is the most valuable asset that the person has by far, is their company. Like that, and so it's a huge decision, and it's not, just an individual decision. It tends to be a family decision as well. And so to Vanessa's point, I think it's important to have the conversation. It doesn't necessarily mean you're going to sell, but if you sit there and look at it and you say, okay, this is coming through, you are going to live with it at least until the next administration. Do I want to sell now and, a lower tax rate? Do I mind if I'm going to hold on to the company for 3 more years and pay a higher tax rate? Am I willing to gamble for the next administration if there's a next administration in 3 years or 7 years? I mean, all of that stuff is important for you to think long and hard about, particularly as we're coming through out of this pandemic. And most of the companies we're seeing are doing well. I mean, now we're not invested in like restaurants and stuff like that. I actually think even restaurants are doing great these days. But you also have to take it against where you are in the economic cycle and your business performance. And so I think you'd be remiss if you were thinking about selling in the next 3 years not to at least put some real hard thought into it.
Any final comments from the panelists before we open it up for Q&A?
I would just echo what Vanessa and John said, that, acting sooner rather than later, or at least taking those steps so that you can act sooner rather than later is an important part of the process. A lot of these things can be very complicated, and you don't want to be rushing at the last minute to try to execute something, especially in the gift and estate planning. You want to understand what those documents that you're signing are doing, and so if you can start now and have a plan, and then if the law doesn't change, you've at least are prepared for even future changes, or you may learn something in the process that helps you go ahead and execute now, even without considering the tax law changes.
While we're waiting to see if we have any other questions, I've got another one, because we're talking about having business owners migrate to doing something that they haven't been doing because they've spent their life building their company. Any advice for them on, from a financial vantage point, they get their value of their company, it's now liquid. Any advice on what they do with that? Or John, just your observations of what a lot of your sellers have done with the money that you've wired them.
Well, the reality is I don't know. They certainly live a pretty nice life afterwards. I've witnessed that. You know, everybody's kind of got different interests, and a lot of the people we actually do transactions with stay involved with the company, actually. Now, maybe they'll kind of like have a plan where they don't want to work as hard, or they want to become chairman, and you know, we kind of work on those plans together. But you know, I actually don't think we've ever made an investment where somebody's actually just totally walked away from the company that's a business owner, because usually they still want to participate. They still kind of want to see the upside. They want to be involved with the growth, and when we get involved, it should be an exciting opportunity for the company because we focus on growing the business. You know, I can tell you a couple of our former founders play a lot of golf and do a lot of fishing these days. So, you know, I think it gets balanced out pretty well.
Yeah, I'll say, just to echo that, you know, I think it is a big transitional change, and I've worked with some clients on you know, after the fact that it's a whole new life. So in some ways it's very invigorating for the business, you know, the ex-business owner, that they really get to map out what life looks like and what do they want to spend their time on, whether it's philanthropic interest or other businesses or spending time with family and whatnot. But, you know, part of that conversation that we try to map out what that ideal life looks like is bringing in the team of experts. It's the wealth advisor, the tax expert, the estate planning attorney, to help map out the plan that really is catered toward that family or that individual. And one thing I always remind people is basically when you're gone, your money either goes to your heirs, to charity, or to taxes. So with pre-planning, you can dictate what that allocation looks like to a certain extent.
Any final thoughts from any of the panelists?
One final thought that I would say is, you know, we've been talking about proposed tax law changes and you know, based on what it was presented in the Green Book, but taxes are complicated, and so if you're looking at you know, having a transaction or wanting to understand how these proposals would impact you directly, you know, you need to talk to your tax advisor, because, you know, as John kind of mentioned, you know, everybody's circumstances are different, and you know, how you own your business, whether it's an LLC, a partnership, an S corporation, a C corporation, you know, all of those aspects, as well as what your other income sources are, and what state you live in, can make a huge difference in your tax situation. So, you know, find a trusted tax advisor and let them help you, you know, understand how these proposed changes would impact you directly.
Great, thanks. We do have a question. The presumption is that the new tax laws will be approved by the Senate, and the Democrats having the VP tiebreaker vote, they will get passed. Have any Democrats in the Senate publicly come out against these changes?
I know a lot of focus has been on Senator Manchin, and I think there was a lot of expectation that he would temper some of these tax law changes, and I think that's still a possibility, but my understanding is that he came out recently indicating that he would probably vote for the reconciliation bill, where the Democrats in the Senate with the Vice President would be able to pass the tax law changes without any Republican support. And so at this point, I think you know, there will be negotiations, and you know, there's a lot of items that have been in the Green Book for years and years and years in administrations that never get passed, and there's lots of laws that have been proposed that never get passed, but the momentum definitely seems to be towards tax increases, and I don't think any of the Democratic senators have said, no, I won't vote for any tax increases.
Last question. So if I'm a business owner and I'm paralyzed to try to make a decision, give me the pitch me or MLR, and then you, John, on why I should at least have a conversation with either MLR or a PE firm. How would that benefit me?
I think at least from MLNR's standpoint, you know, speaking again to a tax professional or investment advisor, you can make all the considerations of what the specific impact is going to be for you. And I think, again, that'll help you evaluate what is a fair sales price, looking at the after-tax proceeds, and just thinking through on timing issues.
Right. John?
Yeah, I mean, I think, you know, when I look at it from the business owner perspective, I mean, first off, I'm biased. I'm a private equity person. So, you know, I have a vested interest in saying, like, you should always talk to private equity people. Not all of them are created equal. Some are friendlier, some are more institutional. I think, you know, if you're thinking about going private equity, it's good to find somebody who fits with you, culturally fits, personality fits. You know, that's probably, you know, these are people you're going to work with, potentially, depending on the structure of your sale, for, you know, 5, 7, 9 years. I mean, this is a relationship you'll be having with somebody. It's one of the reasons why we rely so much on such a relationship based thesis that we have here. But you know, the other thing for people to consider is, you know, particularly, you know, a private equity firm like ours is really focused on growing your business. Like, how can we grow it organically? How can we grow it through acquisitions? You know, how can we take your business and double or triple it in our investment time frame? And that's really what we're trying to do. And so, you know, a lot of business owners that we've done something with took a whole bunch of chips off the table at close, still owned a bunch of the business. And, you know, you kind of look out and, yeah, it might be a higher tax rate, but I can tell you on a quarter of our transactions, we were successful enough growing the business that the business owner made more, even after tax, at the second bite of the apple than they did at the initial, you know, transaction. And part of that is risk driven. I mean, you know, we're corporate finance people. We're willing to take more risk. It's not the only asset that we have, and a lot of the business owners, this is their net worth. And, like, you know, are they going to be as aggressive with investing in their company, opening new facilities, doing add-on acquisitions? Probably not. I mean, and we have the capital and the risk profile to really accelerate that growth for that second bite.
Great. Thank you. Well,
John, I assume even taxes aside, even companies that may be just looking to have some sort of succession plan in place, if they don't necessarily have it mapped out internally, it's helpful to have those conversations with firms like yours in those instances.
Yeah,
so to wrap up,
I mean, and a lot of what we actually end up doing with companies is trying to understand, like, the management team, the ownership, and trying to figure out, like, how to do that succession planning with them. Where do they want to be in 5 years? You know, where on the team does there need to be an upgrade, or is there a hole? You know, if the vision is to get here, how are we going to get there with the executive team? And then also, how's everybody on that team going to make money together? Because, you know, it's very important to have an alignment of interest for what we do. And so we want all the key stakeholders to have some skin in the game and have an opportunity to make money.
any last thoughts? Well, we want to thank everybody that joined us. Your time is valuable. We hope you found this to be educational. Thank you, Vanessa and Dana and John, for your time and responses. And it's a wrap. Thank you all.
Thank you, William.
Thanks,
Thank you, everybody.
Bye.
Bye.